We're not that far into 2026, but it's already been a pretty good year for just about every asset class. Stocks are up, bonds are up. But the thing that most people are noticing is the fact that precious metals are up well in excess of other asset classes. Silver, as of this recording, is up almost 25% year to date with massive volatility along the way. But when we get returns that strong over this shorter period of time, investors tend to not worry so much about the volatility they experience. But the question is, why is this happening? What could cause it to continue? And what other things are we looking for in the economy and the markets to signal that this is a durable trend in precious metals prices? Here you can see the very clear and obvious parabolic move that we've seen in both gold and silver, which you can tell from this chart tend to be very correlated over time. Gold has more of a pure monetary purpose in investors' portfolios, including many institutional investors like central banks, sovereign wealth funds. Silver has more practical industrial uses, which may be influencing some of the demand at the moment. But you can see that there's not that much to separate the two over time. We have seen these sort of parabolic moves, perceptions that there's shortages in the past, perceptions that there's going to be rapid debasement of currencies, which tends to lead investors to want to invest more in precious metals. But we haven't seen quite this size of a move in dollar terms, again, as these metals have risen in price over time. So the question is, what's causing this? Well, we know that central banks have been buying more gold than normal. We don't have data yet for the fourth quarter, but on a rolling 1 year basis, we can see that the amount of gold that central banks have been buying has been unusually high. And a lot of this is coming from China, not all of it. Central banks are clearly diversifying their holdings away from, for example, dollar-based assets or other sort of sovereign debt that they traditionally hold in these very stable portfolios. And the fact that gold is getting this additional source of demand is undoubtedly causing some of the rise in price. In the case of silver, there may be some of that happening as well, but we also know that there's more industrial uses for silver. Silver's used in a lot of production of energy, renewable energy technology involves silver. It can be substituted in or out for other types of metals. As silver becomes more expensive, it makes more sense to use nickel or zinc or copper when you can in the industrial process. So there has been historically more of a cap in terms of how high silver prices can go because those industrial buyers simply won't pay a certain amount of high price for them. You can also see here that the spread between the price of silver in Shanghai versus in New York and other places in the world has been unusually high, which tells us that a lot of that excess demand may be coming from China. There's also been some export controls on silver, again, to try to control some of the price domestically in China. This gap is not as severe as it was earlier this week or even the prior week, but it's still unusually high, which tells us that there still is either a supply shortage or at least a perception that there is a supply shortage. And that has enabled the price to continue to receive support around the world. What we normally look for, though, when we're talking about precious metals is evidence that there are some concerns about monetary policy being too easy, currencies being too weak, interest rates being too low, inflation expectations potentially going higher. We haven't really seen that. We wrote a gold piece late in 2025 that pointed out a lot of these things that typically go into the pricing of gold. One correlation historically has been when you see falling real interest rates, which we use tips to measure in the United States, that tends to be a time when gold is doing particularly well. And indeed, that was the case. From 2023 into 2024, we were seeing a rapid decline in real interest rates as the Fed got set to cut rates after raising them a lot in 22. But at some point, the drop in those real interest rates slowed down and has basically stopped. And you've seen gold continue to price higher. So it's not necessarily what the central banks are doing currently or the perception that real interest rates are going to be lower over the next couple of years that's moving gold prices higher. Similarly, if you look at the flip side of what goes into pricing in treasury yields, you have real interest rates and you also have inflation expectations. Over the long run, we use 5 year forward inflation expectations here. There has not been any change. In fact, this has been unusually steady over the last couple of years in investors' long run perceptions of where inflation is likely to be. And so this is not the thing that's driving central banks or other investors to want to own gold. They may perceive that there is going to be higher inflation in the future, but they're not willing to put their money on it in the tips market. They are willing to express a view that gold and silver prices will be going higher. And the dollar did decline last year, mainly in the first half of 2025. It's been very steady since then. You can see on a historical basis against other currencies, at least other fiat currencies like the euro, the yen, British pound, it's still historically quite strong. So if you do see a decline in the dollar, that may already be accounted for in the gold price, because the gold price can be forward looking, because a lot of the demand for it is based on speculation that something else is about to happen. We just aren't seeing those things happening in the bond markets, in the currency markets at the moment. The lesson for investors here is that you can see these rapid changes in prices over time. Gold and silver have gone up very quickly. This is not the first time this has happened. These periods tend to be followed by periods of rapid declines in metals, or very long periods in which the prices of metals don't really do much at all. We saw that on the very first chart. You can see from the spike in 2011 through the spike that began just after the COVID pandemic, gold and silver prices had been declining for many, many years. That has the potential to happen again after we had this very, very large run up. If you look at diversified portfolios, 60/40 portfolios, to take an example here, if you add 5% to those portfolios carved out of stocks and bonds, you can see these two lines are basically right on top of each other. This is the performance of a portfolio since 1990. There have been times where you've wanted to have that 5% allocation to gold and times where you really didn't want to have that 5% allocation to gold. Over time, it's tended to kind of come out in the wash. So if you do feel more comfortable in your portfolio holding somewhere between a 2 and 5% allocation to gold, we don't have any objections to that. We just don't think it's going to be massively additive to returns over time. It's likely to neither contribute significantly nor detract significantly from the performance of a portfolio. We'll have a lot more to say about this, especially if the gold and silver prices continue to run up. Also, check out our weekly Edge pieces on our website, NewEdgeWealth.com. Thanks very much.